All right, let's jump right in. If you've been looking at the market today, you might be feeling, well, a little bit bored maybe. It looks calm. But here's the thing, that is not calm. That's compression. Think of the market as a tightly coiled spring, just getting wound up before a huge Fed announcement. And in this explainer, we're going to break down exactly what that means and, more importantly, how you can navigate it. So the whole idea here is this concept of a compression day. This is basically the market holding its breath. It's trading in this tiny, tiny range. Any move up or down just kind of fizzles out, and nobody has any real conviction. Everyone is just waiting for the same big thing, that catalyst.
And I really have to hammer this point home because it is the single biggest mistake a trader can make right now. This is not a trend day. Seriously, if you try to trade this environment like it has a clear direction, you are just asking to get chopped up by a bunch of false moves. So here's our roadmap for today. First, we'll talk about this calm before the storm. Then we'll get into the difference between what you see on the screen and what's really happening. After that, we'll map out the hidden risks, find those critical trigger levels, and wrap it all up with an action playbook. Let's get into it. So let's start with that surface level mood. I like to call it a polite risk-on day. It feels okay, but it is so fragile. It's not being driven by any real belief in the market's direction. It's really all about positioning. So what does this actually look like? Well, you see green on your screens, maybe the dollar's a little bit soft. Everything looks fine. But there's no energy, right? There's no aggressive buying that's pushing things higher. Moves start and then they just die. The strength you see is super selective. It is not broad-based at all. And we can actually put a number on this lack of trust. The market's intraday range today, it's a full 30% smaller than its recent average. I mean, that's a huge data point telling you just how coiled and compressed we are. The market is screaming that it doesn't want to move until it has a very good reason. And this brings us to, honestly, the core idea of this whole explainer, the critical difference between the price you see on your screen and the underlying reality of the market regime. It's like you're getting two different signals, and you have to know which one to listen to. So on the surface, you've got the price reality. Equities are up a little, the dollar's sideways to down. Looks pretty good, right? Politely risk on. But underneath all that is the regime reality, the actual plumbing of the market. And that's telling a totally different story. Liquidity is tight, yields are restrictive, and the whole environment is just low trust and fragile. And guess what? That's the one that really matters. Okay, so if we know the whole system is fragile, how do we start to map out where the hidden risks are? Well, to trade this kind of market safely, we have to stop looking at just the price and start looking at the true drivers that are hiding underneath. And here's the real order of operations. Everything, and I mean everything, starts with yields. They are the number one trigger. After that comes liquidity, because that's what's going to determine how fast and how far things move. Then you look at positioning to see who's caught offside. And only then, at the very end of all of that, do you get price. You got to remember, price is the symptom. It is not the cause. So let's lay this out on a risk map. You can see the pressures pretty clearly here. Oil is hanging tough, which keeps that inflation story alive. Yields? They're stable for now, but they are that super sensitive trigger we just talked about. Equities have a bid, but we already know we can't trust it, and pretty much everything else is just stuck in the mud, waiting for a signal. Now this brings us to volatility. The VIX, the market's so-called fear gauge, might look calm, but that is completely misleading. The real risk is hiding in bond volatility. So the main takeaway here is that this compression we're seeing in volatility, that's not a sign of safety. No way. It's a flashing light that a huge expansion, a big move is just around the corner. We just don't know which way yet. Okay, so if we know a big move is coming, how do we get ready for it? Well, we shift our focus. We stop trying to make predictions and start trading specific levels. Think of these levels as tripwires. When one of them is crossed, we know the whole market state has just changed. So for the risk-off scenario, the single most important number you need to have on your screen is on the 10-year yield. If we see a decisive break above 4.35%, that's your trigger. That's the signal that the risk-off move is accelerating and that whole polite mood is officially over. Now on the flip side, if yields break down instead, the level to watch is 4.15%. A clean move below that would be the signal for a potential relief rally, a risk-on move that actually has some real energy behind it.
And in equities, the line in the sand for downside conviction is 5,600 on the S&P 500. If we lose that level after the Fed announcement, that confirms the bears are taking over. Until then, any selling you see is probably just noise. So, knowing the what, the levels, that's half the battle. But the other half, and frankly it's the more important part, is knowing the when. When is the right time to actually pull the trigger on a trade? And that brings us to our final section, a clear, actionable playbook. This is your framework for safe execution in the middle of all the chaos that is probably going to follow that announcement. Okay, the single most important rule here is patience. The first 60 to 90 minutes after the announcement is pure noise. It is full of head fakes and whipsaws that are designed to trap you. The real tradable move, the one that shows you what the market truly intends to do, almost always comes later, in the New York afternoon. You have to wait for it. And this all boils down to discipline. You wait for your levels to be confirmed. You trade the expansion in volatility. You don't try to guess it beforehand. Use the levels we talked about, not your opinion of what should happen. And whatever you do not chase that first move. It is almost always a trap. So to wrap all this up, here's your final checklist. When the news hits, these are the only 4 things you need to be focused on. Number 1, how do yields react? 2, what is the speed of that reaction? Remember, velocity matters more than direction. 3, do equities actually follow through? And 4, does the breakout confirm or does it fail and reverse? That's it. That's the entire game right there. And that leaves us with this final, crucial idea. In a coiled, fragile market like this one, having a really strong opinion is a liability. Success is not going to come from blind conviction. It's going to come from patience, from good timing, and from disciplined execution around a clear set of rules. You have to trade the market you have, not the one you want.